Welcome back to Brick by Brick, the podcast that unpacks how cities, especially our city, get built, rebuilt, and sometimes left behind. I'm your host, Steve Padernacht, and today we're zeroing in on a milestone that's personal, financial, and political: buying your first home. Whether you're dreaming of a one-bedroom co-op in the Bronx or just trying to figure out what a pre-approval letter even is, this episode is for you. We're answering the top questions first-time buyers are asking in 2025, from timelines and down payments to what really happens at closing. And if you're overwhelmed, that's not a bug in the system. It's part of it. We'll also walk through the timeline of a typical buying process so you can see where you are, where you're headed, and what you need to do next. Why now? Because homeownership is still the biggest wealth lever most people ever get. But in a city like New York, where the market feels like a maze built for insiders, it's easy to get stuck at the starting line. So we're breaking it down brick by brick. Let's get into it. So what I really want to do today, folks, is I want to start with some general questions. Just basically a lot of questions that I get as a real estate agent. And usually it's a lot of the same questions, to be honest with you. So one of the top questions I get all the time is, what's the real first step in buying a home? Now, this question can be answered a number of different ways, but I'm going to start with something that is probably a little bit not expected. So what's the first step in buying a home? I think it's figuring out that you want to buy a home, right? You have to figure out why you're looking to buy a home. There's so many people that want to buy homes for different reasons. One reason may be that they are going through a major life milestone. Maybe they're getting married. Maybe they just graduated college. Maybe they just got a promotion at work. And the reason is that now they are financially ready and they think that they're able to buy a home. So that could be one reason. Another reason to buy a home might be that you're looking to just stop paying rent. It could be as simple as that. Think about it. If you go through the math, and you're paying, let's just say, $2,000 a month in rent. That $2,000 a month, and let's say you're renting for 5 years, $2,000 a month is $24,000 a year. $24,000 a year, multiply that by 5 years, you just spent over $100,000 paying somebody else's mortgage. And you're just tired of it. You want to figure out a way that you could build some of that equity for yourself. So I think the first step in buying a home is deciding that you want to buy the home. And the reason why I say this is the first step is because this process is not easy. There's a lot of paperwork. There's a lot of hurdles. It's a lot of ups and downs, peaks and valleys. And you have to be able to move through that adversity and be able to say, you know what, I'm going to accomplish my goals. Now, this kind of goes back to your own personality type. Are you the type of person that gives up easy when you face adversity? Are you the type of person that sets their mind to something and is going to get it done no matter what? So that will help decide how far you get along in the process. So I always feel like when you face those adversities, when you face the moments where, hey, listen, you put in 4 offers and none of them got accepted. You figured out that you may need to go back and you may need to adjust some of your, I don't know, let's just say, for example, you don't have enough income and you need to find a cosigner. That's adversity that you have to face and you have to push through. So if you're not able to push through that adversity, then you're not going to be able to move forward. So knowing your why is important because it will allow you to then go back to that why, go back to that motivation, and be able to push through. So that, I would say, would be the first step. So the next question that I get a lot is, how much money do I need to save for a down payment and closing costs? So there's a lot of first-time homebuyer programs out there, specifically with the FHA, and they have programs that are even as little as 3.5% down. But it depends on what type of property you want to buy. So, for example, if you want to buy a co-op, you're not going to be able to take advantage of an FHA loan. Reason being is because the boards don't allow you to put down that little of a down payment. For some reason, the laws in New York City and New York State in general allow the co-op boards to set their own down payment requirements. So most of them range anywhere from 10% to 20%. So if you're looking to buy a co-op, you're not able to put down 3.5%. You're going to have to come with 10 to 20%. So let's just go down the rabbit hole a little bit for assuming that you're not buying a co-op. Let's say you're buying a single family home, or you maybe want to buy a multifamily home. Let's say that you are able to get approved for an FHA loan and you're putting down 3.5%. So what you have to do is you have to figure out, once you speak to your lender, essentially what you're pre-approved for. So we're going to go with some basic math. Let's assume that you're buying a property for $500,000 and you're putting down 3.5%. Just do the math, right? So 3% of 500,000 is 15,000 plus another 0.5%. So you're talking just under 20K you're going to need just for the down payment. Now, in addition to that, you're going to have closing costs. What are closing costs? Closing costs are completely separate from your down payment. Essentially, they can cover things such as your attorney fee, appraisal fee. You may have to prepay some taxes when you close, depending on what town you're in. Some towns require you to pay, 2 months worth of property tax before you even close on the deal or the day you close. And the biggest fee that you're going to encounter is going to be your mortgage recording tax. So this is something that is kind of out there that not a lot of people know about. Mortgage recording tax is something that is required whenever you take a mortgage on a property. So if you're borrowing if you're putting down 3.5%, that means you're going to have a mortgage of approximately 96.5%. So let's just go based on your math of our scenario, buying something for $500,000. If you're putting down 20K, you're going to take out a mortgage, which means the bank's going to lend you the $480,000. You usually have to pay, I think the mortgage recording tax, and it differs in different localities, but the average is anywhere from 1.5% to 2.5%. So you have to pay a percentage of whatever mortgage is being recorded as part of your closing costs. So that could be a big number. If you're buying a property for $1 million and you're recording a mortgage of $900,000, you're talking about, listen, at 2%, you're putting down $18,000 literally just to record the mortgage. This doesn't go anywhere but the state. It's just a way for them to make more money. Talk to your local, congressman or whatever about figuring out how to get that taken out. But that's just out there. That's something that you have to, just account for. As of August 17th, 2024, they changed the laws regarding buyer broker fees. What they did was they put clarity around the fact that the sellers are not required to pay the buyer agent. So, which means that you, the buyer in this situation, have to be responsible for covering the agent's fee. Now, a lot of times what's happening in the market, and whenever laws like this change and they shake up the industry, it takes a while to figure out exactly how people are going to navigate around it. What I'm seeing a lot is that sellers are still offering at least part of the compensation to buyers' agents, but you have to account for it. So, easy rule of thumb, just to kind of wrap this up in a bow, you're going to need your down payment, whatever it may be, whether it's 3.5%, 5%, 10%, or 20%, you're going to need that money. Plus, you're going to need your closing cost, which I always tell people, be prepared to pay anywhere from 3 to 6% of the purchase price. Two separate things there, the down payment and the closing costs. So I hope that gave you some clarity around how much money you're going to need. Next question I get a lot. How do I choose the right mortgage type? FHA, conventional, VA, etc. This question is really geared more towards your personal finances and your long-term goals. The VA loans are amazing vehicles, but if you're not a veteran, you're not going to be able to qualify for a VA loan. FHA loans are amazing products, but if you're not a first-time buyer or you don't have necessarily the ability to have the, let's just say you don't want to pay a crazy mortgage recording tax, you're not going to want to look at an FHA loan. Also, FHA loans, just so we're clear, there's a lot more red tape with them. And what I mean by that is that because they're federal loans, you're required to go through a lot more of a process, a lot more paperwork, and also the appraisal and the inspection periods can be a little bit more time consuming. So again, if you don't want to deal with that, then an FHA won't be good for you. Conventional loans are probably the best product out there. And that's just because they're the most cookie cutter and most people fit more into a conventional loan. But if you have, let's just say you have poor credit, you might not qualify for a conventional mortgage. Let's say you only have 3.5% to 5%. You will only qualify for an FHA loan. Let's say you're a veteran, you're going to lean more towards the VA loans. The bottom line is the right mortgage type really depends on your own situation. And what I would suggest you do is you talk to a qualified lender. My lender of choice is the Loan Depot, Christian Babcock, Michael Plata, that team over there. They're extremely well-versed, and figure out what's right for you. There is no cookie cutter answer to this question. It really just depends on your own personal finances. So let's see. Another question I get. Oh, here's a good one. Is it better to buy a co-op, condo, or single family home in New York City? Well, let's just make something very clear here. Co-ops are very, very unique to New York City. Now, again, I'm not in all 50 states, so I don't know if there's co-ops in other parts of the country, but here in New York, co-ops are plentiful and they're very unique here. And the reason why I say that is because they are they're a home type, or they're a type of asset that you're not actually buying the property, right? So let's just kind of go into the difference between a condo and a co-op. The main difference is that when you're buying a condo, you're actually buying real estate. When you're buying a co-op, you're buying shares in a corporation. Think about it. The way I tell people to think about it is almost as if you're buying stocks, which actually, when you close on a co-op, they do give you stock certificates. So if you have a building, let's just say that has 100 units, nice round number, and you buy one share into that building, they're going to give you as collateral 1 unit. So you're buying the stocks, but your collateral really is the unit that you get to occupy. And then what happens is you have to get what's called a proprietary lease. And then that allows you to lease the property in perpetuity while you still own those stocks. A condo, on the other hand, is you're buying a deed to a property. So again, huge difference between co-ops and condos. Co-ops require you to basically be a shareholder. Condos require you to own the actual property. Single family house, very similar to condos. What they are is you're buying a deed to a property. So back to the original question, is it better to buy a co-op, condo, or single family home? Again, this goes back to your personal situation, right? Like, let's just say you're somebody who values their privacy. Let's say you're somebody who doesn't want to have neighbors. You want to live on a piece of property that doesn't have people that are literally sharing a wall with you that might be with a co-op or a condo. Or maybe you're somebody who grew up in apartments your whole life and you're like, you know what? I just want to build some equity, so I'm going to go into a condo or a co-op situation. Again, no cookie cutter answer here. It really depends on your own personal situation. Here's a great question I get. How do I know if I'm overpaying in this market? Right now, on a national level, we're having a major situation of lack of inventory. Now, I'm going to use very broad sort of stats or examples here. And the reason why I'm doing that is because the number one question I get, and I'm actually, you know what? Let's just go back to that. The number one question I get is really, how's the market? I mean, literally every single person, once they find out you're in real estate, they ask you, how's the market? So me personally, when people ask me, how's the market? I flip it on them and I say, well, it depends on why you're asking. Are you looking to buy? Are you looking to sell? What market are we talking about? Are we talking about New York City? Are we talking about statewide? Are we talking about Westchester County? Are we talking about on a national level? Are we talking about commercial? What is it that you want to know? And then I can help gear my conversation or gear my answer towards that, right? Because in this market right now, the commercial market is completely different than the residential market. The residential market right now, overall on a national level, we're in a seller's market, which means that there is a lack of inventory. Sellers can basically dictate the terms and the prices for the market. And that's because interest rates are extremely high right now. And let me go back. Interest rates are higher than they've been over the past, 5 to 10 years. we were very, very used to in this market having interest rates that range anywhere from, 3% to around 5.5%. Currently, at the taping of this, we are just under 7%. The average 30-year fixed is at 6.93. What does that mean? That means that if you're a seller, and let's just say you bought 7 years ago, 10 years ago, and you have a mortgage rate of, let's just say 3% or 3.125%. If you sold your property now, even though you'd probably have a windfall of money, meaning that you've gained enough equity in time, since you bought the house to now in a relatively short period of time, you're going to then become a buyer in a market where there's, number one, lack of inventory, and your interest rate is going to be a lot higher, almost double in some cases than what you're paying now. So a lot of sellers are saying, you know what? To hell with this. I'm not doing that. I'm going to wait until rates come down a little bit. And once rates start coming down, then you're going to see more sellers on the market, which will then loosen up the inventory a bit and then allow the market to start shifting more towards a balanced market. So if we're going back to the original question, how's the market? It really depends on why you're asking. I just gave you a very simple sort of scenario when it comes to residential, but if you're looking in commercial, then we can have a different conversation. I don't want to go too far into commercial because I feel like there's not too many people that are necessarily watching this that are into commercial, but just know that I am very well versed when it comes to multifamily investing. So apartment buildings that range anywhere from 6 to 60 units, even larger than that. I've been involved in plenty of transactions. I've managed properties upwards of 230, 250 units. So I can answer questions regarding commercial as well as residential. And that's an advantage of working with somebody like me that actually has not only been helping people buy and sell, but actually have bought and sold myself. It separates me. And this will kind of go back to the next question that I get a lot of times is, how do I know what agent to pick? This is a simple question. Go with your gut, right? Just make sure that you feel comfortable with the person that you're working with. Make sure that they've demonstrated that they have experience in the type of asset that you're looking to buy. Make sure that they have the know-how and they have systems in place and they have ways that they're going to be able to communicate with you properly in a timely manner and in a way that you're going to understand. A lot of times there's a lot of different sort of complicated lingo that is involved, and they have to be able to break that down and explain it to you. So make sure when you're choosing the right agent, you're choosing somebody that you have a good gut feeling for. And I'll just add as a part B to that, they can see, or you can see, and they can prove to you that they have experience dealing with the asset type that you are familiar with buying or that you're looking to buy. So those are some of the general questions that I get when it comes to buying a house. Now, what I'd like to do is kind of go through the timeline for buying a house. A lot of people ask me, how long does it take to buy a house? How long does it take from the time that I get my pre-approval to the time that I actually get my keys? And that could range. That could range. I mean, if you're buying cash, right, and meaning that you're not going to a bank and getting a mortgage, then you can close in as little as 30 days. If you're getting a mortgage, the average timeline is probably anywhere from 45 to 90 days. So if you're looking to buy a house, let's just say the main reason for you wanting to buy a house is because you want your kids to go to a better school. Make sure you give yourself enough time. And that's why like April and May are really big months for realtors and for real estate transactions, because people are planning for that next school year. So just make sure that you're giving yourself enough time to be able to get into the situation and you're not cutting it close where, you're looking to change schools in the middle of the year, because who wants to put their kids through that? Who wants to have them start school in September and then pull them out in October or November? Or if they don't want to pull them out, listen, I've seen situations where people drive 30, 40, 50, almost over an hour for their kid to go back to the same school because they didn't want to pull them out. Again, sometimes you can't stop those scenarios. So if that has happened to you, just understand that I sympathize, but let's try to set people up for success so they don't have to necessarily do that. So let's go through the timeline a bit. First step in the home buyer's timeline is signing an agreement with a realtor. I know some people might be surprised by this, but you can kind of go back and forth, right? Like some people say, well, let me research the area, or let me try to figure out what neighborhoods I want to move to. But the problem is that you might not have all the information. And speaking to a realtor and signing an agreement to work with a real estate agent is probably the most important step in the timeline. Reason being is, listen, this is what we do every single day. Would you walk into a court of law without an attorney? I get it. Some people do. Some people choose to go in there and represent themselves. But why would you choose to do that? I mean, you're going to basically go into it without having an expert by your side. You're kind of setting yourself up for any sort of mistakes. I don't want to say setting yourself up for failures, because there's plenty of people who don't use real estate agents, and I'm not knocking you guys at all. But me being a realtor, seeing people get taken advantage of, seeing people not knowing how to negotiate, seeing people, walk into homes and buy homes that they were not told that they should probably get an inspection on. I've seen some horror stories. So for me, in my timeline, and again, this is Steve's timeline, this is not everybody's timeline. First step, sign an agreement with a real estate agent. Remember, I said August of last year, they changed the rules. So if you don't have an agreement with the real estate agent, it makes it very difficult for you to go see homes. Part of that law that changed is that I can't show a house to you unless we have an agreement in place. Now, there's caveats to that, right? So like, you're more than welcome to tour open houses. You're more than welcome to come and tour one of my personal listings. But before you walk into my personal listing, I have to have the conversation with you that asks, are you being represented by an agent? If you say no, I say, okay, well, you have two options. The first is you could tour this home as an unrepresented buyer, and I have a piece of paper that you would sign indicating that. The second option is you could tour this home and I can act as what's called a dual agent. Now, a dual agency means that essentially I'll be representing you and I'll be representing the seller. There's nothing wrong with this. As long as you disclose it and everybody knows and your seller's okay with you acting in that capacity, that's fine. Third option is you could tour the home as a dual agent, but with designated realtors. So for example, in my situation, what I do a lot of times is if somebody wants to tour my home, I say, okay, well, you have the option. You could tour as unrepresented. You could tour as a dual agent where I could represent both parties, or I can actually recommend somebody. And I usually recommend my fiance and my partner, Jen. And then in that situation, she's representing the buyer. I'm representing the seller. And the most important thing you get when you sign an agreement with somebody is you get what's called fiduciary confidentiality. Now, fiduciary means that I'm looking out for your interests. I'm looking out for your best interests, your best concerns, everything that you want to make happen. I'm working for you. If I'm representing both people, it becomes very difficult to do. So I try not to get into that dual agency where I'm representing both. I try to make sure that there is some sort of barrier between myself, my clients, and the other person. So step one, sign an agreement. Step two, research neighborhoods, research properties. Now, you might have a general idea. I want to be in an area where there's good schools. I want to be in an area that's close to transportation. I want to be in an area where possibly I could find a better job. Your real estate agent is going to know what areas are better suited, or they could recommend areas that you might not know about. I think that the most important part of that situation is identifying what your wants and needs are. So for me, what I try to do is I try to say, okay, let's start with two sides of a piece of paper. And we say, okay, what are your wants? And I would list all your wants on one side. And then I would say, what are your needs? And then my job, if I'm representing you, is to go out there and make sure that I hit as many of those boxes as possible. But I focus on the needs. Do you need to have parking? Do you need to have laundry? Do you need to have some sort of outdoor space? Do you need to make sure that you have a finished basement? Those are the things I'm focused on. And then if I can somehow get to the wants, then at that point I start tacking it on. And now all of a sudden, even though you listed 20 different things, I hit 17 of them. I go back to your original conversation where I say, hey, remember you asked for X, Y, and Z? Well, you got X and Y, and we've looked at 50 houses already. Well, let's not say 50 because people are going to start getting, scared of that. You've looked at a bunch of houses already, and this is the best option on the market right now. And your kid is starting school in 3 months. So let's figure out a way, because we know darn well that you don't want to have to travel an hour and you don't want them to go back to that same school that they've been at. So researching neighborhoods, researching properties, that's going to be the next step. And you're going to do that in conjunction with your realtor. Okay. Next thing is pretty simple. It's viewing properties. Now, what we'll do usually, and how I present it to my clients, is I say, okay, so, we already know what you do for work, right? Let's just say you work a typical 9 to 5. That means that you're available usually on weeknights or weekends. It's funny, us realtors, we work schedules that people don't necessarily work. So we have to make ourselves available usually between 6 to 8 p.m. on weeknights, and either Saturdays or Sundays, or sometimes both, to be able to work around your schedule, which is okay. This is the life we chose. We're not complaining. But when it comes to viewing properties, we're going to first set a schedule. We're going to say, okay, you're available. Let's just say you do yoga on Wednesdays. Let's say that you do, your kid has baseball on Fridays. So now that leaves us with a certain amount of time that we can go out and look at properties. Now, here's where it gets tricky. We're dealing with 4 different types of schedules. We're dealing with your schedule, my schedule, the seller's schedule, and sometimes the seller's agent schedule. So just understand that for you, it may be like, hey, we're going to go out this Saturday. We're going to look at 5 properties. For me, I now have to do what's the juggling act and figure out how we can get in to see all 5 properties. Now, if you're looking at houses in Upper Westchester, Lower Westchester, then maybe the Bronx, I also have to kind of sit there and work around what makes the most sense, so we're not doing zigzags across the whole map. So the bottom line is, at this point, we're going out, we're looking at properties. I kind of just gave you a little bit about the back end of what us real estate agents do to put that all together. But the bottom line is we're going to look at properties. So at this point, we're going out, let's just say every Saturday from 1 to 4 p.m., and we're looking at some properties. After that, you're going to start seeing some properties that you like. Then what happens is we're going to start making the offer and negotiating the terms. So this part of the process, you have to make sure that your real estate agent knows what gets deals done in this market. Reason I say that is because there's a lot of different ways that you can make the offer a lot sweeter without it really costing you too much more money. Some people will tell you that they will never, ever advise a client to waive an inspection. I personally don't feel that way, and there are other ways around it, right? Like you could do what's called, I'm going to do an inspection for informational purposes only. Inspection is an extremely important part of the process, but if you're in a competitive market like we're in, you might want to say, hey, you know what? I'm going to waive what's called the inspection clause. And the inspection clause or contingency means that if we do the inspection and we find out that, let's just say, I don't know, I'm going to use something, that's pretty common in this market. You're going to find out that maybe there's a retaining wall in the backyard that's leaned over, and it might cost you $5, $6, $7, maybe $10,000 to repair. You're not going to go back to the seller and say, hey, you know what? That retaining wall is falling down. I'm going to reduce my offer by $10,000. So when we're making offers, we have to just understand that there are certain things you could put in there that will make sure that will entice the seller, right? Like maybe me as a realtor, what I do is I always ask the seller's agent, like, what's important to your seller? Do they need time to find something else? Do they care more about price, or do they care about terms? Some people will take less money. Some sellers will take less money if you have better terms. It's not uncommon at all. I actually just had a deal not too long ago where the seller received an offer that was higher than mine, but because my buyers had a larger down payment and because they were waiving their inspection contingency, they ended up taking that one. So having a good real estate agent will help you put together the terms of your offer that will give you the best advantage to close on the deal. Next part is going to be going back to, I said, the inspection, right? So let's assume that you do have an inspection clause and we hire an inspection. And big shout out to Josh and Lisa at Stone Home Inspections. They are absolutely amazing at helping first-time buyers, especially, get into the buying process, right? So what you do is you're going to hire Stone to come in there and they're going to go through the home with a fine-tooth comb. And what that means is, listen, especially if you saw the house if you saw the house for the first time, maybe it was during an open house or you spent maybe 5 or 10 minutes in the house, there's no way for you to be able to know everything that you need to know about that property. So what the inspection process is, they come in and they look at the entire house. They usually spend, depending on the size of the home, anywhere from 1 to 3 hours in the house, and they're checking for mechanicals. They're checking for, any sort of structural issue. They're checking windows. They're checking vents. They're checking electrical. They're checking plumbing. They're checking for, termites. They check for radon. They check the roof. They check the age of the roof. They check for insulation. And these are just some of the things that the inspectors check for. So what's going to happen is you're going to go through the process. You're going to hire this inspector. They're going to come in. They're going to look at the house. Then we're going to get back this report. And I'm telling you, this is not for the faint of heart, but you're going to get back a 75-page report. And if you're the type of person that doesn't necessarily like reading 75-page reports, guess what happens if you have a good real estate agent? They will read the report for you and they will give you the good old Cliff Notes. And they'll say, look, I went through the entire report. Here is the general gist of it, right? Like, I've seen situations where it's like, the electrical outlets are not grounded. Okay, that's a really simple fix and it's not necessarily something that you should kill a deal over. I've seen situations where they're talking about the roof has 5 layers. And you have to be able to, me, the realtor, what I do for my clients is I explain what does that actually mean. Now, 5 layers, I believe, is against the law. So that might mean that you're probably going to have to put a new roof on the property. But if you're okay with that and you've already lost out on 10, 15, other homes or 3 or 4, whatever the case may be, you might say, you know what, Stephen, I'm good with it. I'm planning for putting a new roof anyway. Point of the matter is you're going to get back to 75-page report and I am going to sit there and go through it and give you the most important items and the items that I think you should focus on. So that inspection process, I'm with you literally up until this point, every step of the way. Next is your contract signing. So going back 2 steps ago with the terms that I was able to negotiate for you, I am then going to give the attorney that's representing you what's called a memo of sale. That memo of sale will then allow the attorney to help draw up a contract. And in New York, it's primarily 99% of the time, the contract is written up by the seller. And the seller is the one who tries to dictate the terms of the transaction. Of course, they're not going to take everything out of it that you wanted to negotiate, but they will try to get through and they will try to, maybe pull a fast one. And I'm not saying attorneys are bad by any means, but they're looking out for the best interest of the seller. So what I do is I work with your attorney to make sure that all those terms that were important to you when we presented the offer are still in the contract. And they're still there. So that way, whatever paperwork you're signing is exactly what we agreed to when we put that offer in and got the accepted offer. So I work extremely close with attorneys on a daily basis to fight for my clients to make sure that they're getting the terms that we agreed to. New York is an attorney state. So the attorneys are the ones that handle the contracts and they handle the terms. Now, for all you attorneys out there, if you're listening to this, please do me a favor. Be a little better when it comes to working with the realtors, and you know exactly who you are. So if you're watching this and you're saying to yourself, what are you talking about, Stephen? Then you know that that's you, okay? we're the ones who are on the front lines. We're the ones who are making the deals happen, okay? You guys play an extremely important role, and we're part of a team here. But you attorneys tend to get a bit, I don't know, let me not say full of yourselves, but you think that you guys are the ones that are actually running the transactions. But let's just be clear here, okay? I busted my hump to get to a point where I could have this client sign a contract with me. I, most of the time, have recommended you as their attorney. So please, let's just keep the lines of communication open and make sure that we're working as a team, okay? Some of you lawyers like to kind of go rogue out there. So let's make sure we're working as a team in the best interest of the clients. Okay, that's my rant on attorneys. Once you have contracts signed, we're going to go into what's called the appraisal process. So let's assume that you're getting a mortgage. We have to deliver to the lender, the person that's representing you on the mortgage, we have to deliver them what's called a fully executed contract, which means that you've signed and the seller has signed. The lender then orders an appraisal. An appraisal is a very simple term. And what it means is that they're going to hire a third party to come out and make sure that the home is valued at the same price or higher than what you've agreed to pay. So if you're looking at homes for $700,000, let's say we get an accepted offer, or an AO is what it's called in our industry lingo, for $700,000, they're going to go make sure that house is at least worth $700,000. If it's not, then they're going to say, hey, we can't lend you $700,000. This house is only worth $690,000. So that means we're only going to lend you up to $690,000. So you as the buyer might have to come out of pocket and understand that $10,000 you're going to have to come out of pocket in addition to your down payment and your closing costs. So the appraisal process, what I like to do is maybe if once I speak to the appraiser, if there's any issues, I like to pull some comps and send it to them just in case, as a sort of way to kind of back it up. Because listen, appraisers are people too, and sometimes they make mistakes. Sometimes you get some appraisers that maybe might have missed a comp or missed a property that might have sold around the corner off market. So for me, what I like to do is I like to send the appraiser a list of some properties so that way there's no issues and they can see that the value is there. Now, up until this point, you've done a lot of work, but right now it's your team that's doing a lot of work. So at this point, there's not really much to do, right? So you're going to go through a period of probably 2 to 4 weeks where the bank is just doing what they do. They're going to appraisal, the appraisals, they're going to come back usually in about a week or so. And then from there, they're going to do what's called underwriting review. Underwriting review is they're going to ask you for updated pay stubs. They're going to ask you to run your credit again. They're going to ask you for possibly your taxes. Again, if, depending, maybe you might have, started the process in December, but now we're in February. So all of these things, they're going to go into underwriting, and the bank is going to, essentially do what they do to make sure that you're able to close on the deal. Let's assume that that takes 2 to 4 weeks, maybe sometimes 5 weeks, sometimes quicker, but let's just assume the standard is 2 to 4 weeks. We're going to do what's called title review. So your attorney for buyers, they're going to order what's called title. Now, one clause that is in every single offer that I submit and any realtor submits is clean title. Clean title means that we will do a search. We will hire a company to go out there and order all the paperwork on the property. They're going to make sure that there's a certificate of occupancy that is legal, that if it's a 2-family, it's a 2-family, that there's 3 bedrooms, that we're allowed to have that extra bathroom downstairs in the basement. All of these things can pop up when title is pulled. So they're going to check for certificate of occupancy. They're going to make sure that they're checking to see if there's any building violations or any other violations that may be environmental or something like that. They're going to make sure that the survey of the property, to make sure that meets the meets and bounds. They're going to make sure that the seller actually owns the property and they're able to sell it, right? Like, I've seen deals fall apart because the seller wasn't able to actually sell the property, and maybe it was a cousin or somebody who actually was on the deed, and then we had to go track that person down. So clean title is extremely important. And once title comes back, I work very closely with the attorney to make sure that if there are any issues, the seller has to rectify them before closing. Because you don't want to buy a property that has issues on title, because guess what? Once you close, those problems become yours. So clean title is something that we work on, and we make sure if there's any violations or any issues, we get through. Now, what comes along with clean title, and something that I kind of didn't mention earlier, and I forgot about this, is what's called title insurance. It's part of your closing costs. If you're getting a mortgage, you're required to get title insurance. And basically what that is you hire an insurance company to come in and ensure that the title that you are closing with, or the title that the seller is giving you, is valid. And if there are any issues, even though we've done all of our due diligence, if there are any issues, that title insurance policy ensures that you're not going to have to necessarily pay for those damages, and the title insurance company will pay for it. Now, title insurance usually ranges, on your typical $500,000 to $600,000 purchase, it usually ranges anywhere from like $2,000 to $3,500, and that's a fee that's paid at closing. So we've gotten through why you want to buy a house. We've gotten through researching neighborhoods, viewing properties. We've gotten through making offers and negotiating terms. We've gotten through the inspection. We've gotten through your contract signing. We've gotten through your appraisal process. We've gotten through your underwriting process. We've now ordered clean title. Title has been cleared. All issues there have been taken care of. The last step here is what's called clear to close. Clear to close comes from the lender, and it's a beautiful day. It's an absolutely beautiful day when you get that call and they're like, hey, we've got CTC, or clear to close. And at that point, now we can sort of breathe easy. Now we can kind of say, all right, let's figure out a closing date here. We're almost at the tail end, and you could see the light at the end of the tunnel. So now it's just a matter of getting yourself some homeowners insurance and making sure that you have the funds that are wired into a specific escrow account, right? And at this point, we just set up closing. Now, closing process has changed over the years. It used to be pre-COVID that it was always held in one big room. The real estate agent was there. You're going to have, let's just go through the attendance for a closing, right? You're usually going to have a lawyer for the seller, a lawyer for the buyer, a lawyer for the bank, and you're going to have a title closer. That's at least 3 attorneys. Sometimes title closer is an attorney as well. So that's 4 attorneys in the room. You're also going to have the seller, the buyer's agent, and the seller's agent. So that's 9 people that are going to be present at a closing. Everybody's working together to make sure that this thing closes. So closing day comes. This is the day that you're going to walk into the somebody's office. It's probably going to be one of the attorneys, and you're going to sign probably your signature maybe 50 to 100 times that day. You're going to be just signing away. But you're almost there. And then the title closer turns around and says, we are officially closed. Congratulations. And at this point, you're handed the keys and you're able to walk into your new home. Now, as you can see, and I'm not even sure, my clock is not working over here. I don't know how long that was, me explaining this. All right, but I'm guessing that it's north of 40 minutes. This process is extremely diligent, and there's a lot of things that happen. So it's very important for you to work with somebody that knows what they're doing. And for me, the one thing I want to get out of this video is that you understand that I'm going to be with you. Me and my team, we're going to be with you step by step by step by step. So thank you very much for listening to this process. And I really, really hope that it broke down some of the questions you may have had and the process and the timeline that's involved with buying a home. So this is the Padernacht Podcast, Brick by Brick. And thank you very much for joining us, and we'll see you next week.